Here are 3 reasons why to subscribe to Fringe Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What is going on YouTube, and welcome back to another Wisdom Workshop Wednesday. It is Fringe Financials here, and today I'm going to be showing you one of my new investments that I am adding to my portfolio. So if you're excited to see those, please make sure you smash the thumbs up button, subscribe to the channel if you haven't already done so, and turn on the bell notifications so you don't miss anything that is important. Now, today's investment is all about what is called P2P loans, or peer-to-peer loaning. Essentially what it is it focuses on having people loaning money to other people instead of going to a bank to get a direct loan. Now, today I'm going to show you the pros and cons of peer-to-peer loaning. Let's go over the pros and cons of peer-to-peer loans. First, a good pro of it is that you might get a higher interest rate compared to banks. Now, I know right now with where the market is currently, we have high yielding bank accounts that might give you 3%, 4% return for your money, but peer-to-peer loans could return you a higher interest rate than that. And I'll show you some examples a little bit later on. So having a higher interest rate means that you have more money coming into your account, which is what is a great thing to have. Again, you want to grow your net worth essentially. The second pro is that you have fixed interest rates. So unlike the stock market where the prices go up and then they go down, they fluctuate up and down, peer-to-peer loans have a fixed interest rate, which means that if you're supposed to get 8%, you are going to get 8%. You know you'll have consistent and consecutive amounts being put in and earning interest every single time. It's not going to fluctuate based on the market. The third pro is that it takes as little to start. On Prosper, you are able to start with $25 only, and I'll show you what I have invested on the Prosper account. And the last one I like is that it diversifies the portfolio. Again, we always look for different streams of income. You don't want to have only one stream of income. If you're just working 9 to 5, you don't have money making more money for you. So you want to have different streams of income. So that way if the market goes down, then maybe my peer-to-peer loans might still be having a higher return. You want to have that diversification to really help you grow your net worth. Now, those are some of the pros that I like about peer-to-peer loaning. Some of the cons in peer-to-peer loaning is that it's not FDIC insured. So unlike having your money stored in a bank that gives you like a 3% return on how much money you have, these peer-to-peer loans are not FDIC insured, meaning that if the borrower who is getting the loan paid from you, if the borrower can't make payments and ends up defaulting on the loan, then you lose your money as a result, which is not a good thing. So that's why I'm starting off very small to kind of test the waters to see, how the borrowers are working. Now, I did a lot of research on Prosper just to make sure that I knew what I was getting myself into. I don't just go in blindly and hope for the best. So I did a lot of research and did a lot of, reading up on it, articles and those kind of things. The second con is that it's a longer term commitment. So the loans on this website particularly are 2 years, 3 years, and 5 years. So your money is in fact locked in for that time period. You can't get your money back early if the person pays off the loan faster than the time period. So say you have a 2-year loan that you signed up for and they paid off in 1 year, then you get your money back earlier, but you can't always guarantee that. So your money is a little bit locked up for a longer time than just being able to sell money right away or sell it right away and get the money back out. And again, the third thing is that you are at a little more of a risk because these people might have lower credit scores than, the average person. So the thing is with that is that people that might have a little bit lower credit scores or something going on with their credit, they don't want to go to banks because banks are more likely to reject them from their loans. So they go to peer-to-peer loaning because they have a little bit more freedom to get more loans and be more desired that way. All right, everybody, so we're gonna be looking at one of my examples on Prosper here. Now, as you can see, I only have one loan that I have funded right now, and again, it was $25 only. So if this loan payer defaults on the loan, I'm out $25, which again is why I'm starting off small to make sure that, to kind of test the waters out and see what I'm doing. I don't want to just dump all the money and hope for the best here. So as you can see here, this one is currently going to yield 12.91%, which is, a really good yield return. And what Prosper does is they grade people based on important information like their credit score, their credit utilization, their job, how long they've been working for. And you can see they have a nice grading system up top, as you can see here. So you have AA, which is the highest of the high, A, B, C, and as you get lower and lower, HR stands for high risk. So you gotta be very careful with those. So I have right now an A right now. And as you can see here, it gives you a lot of information about who the buyer is or who the loan person is and what they're doing. So the interest rate is 13.91%, but Prosper takes a 1% fee for finding it. So I'm actually going to be getting a 12.91% yield return as long as this borrower continues to pay money. As you can see, they gave them a grade of an A. The Prosper score is at 11 out of a scale of 1 through 11, so one of the best, so like literally the best score possible. And it tells you what their FICO credit score range is, which is between 720 and 739. So not excellent, but still a really good credit score to have this kind of loan and to be borrowing money from. 0 inquiries in the last 6 months. They've had credit for 18 years. They have 12 credit lines open right now, which is really, really great. They have a huge credit balance of $54,000, which is great. And they have a mortgage that talks about the debt to income, what they're employed as, their income, and their occupation. So it gives you a kind of like an in-depth analysis as to see like what people are doing and what the person or who the person is that's taking the money from you. So I only have one in for right now, but what the point of this is to hopefully allow us to maybe diversify the portfolio even more. So that's my, my new investment that I'm looking at for today, guys. I know it's a short video. Please make sure that if you enjoyed this content for today, make sure you consider liking the video, subscribing to the channel if you haven't already done so, and turn on the bell notifications. I hope everybody has a great day, and we're going to be back here on Friday for my net worth update. Enjoy the rest of your day, everybody, and we will see you then.